Hey everyone, welcome back to Corporate Decoder. Today, Manning and Napier Fund Inc. just filed its semi-annual shareholder report, and I'm seeing some interesting numbers in their financial tables. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report covers the period from the 1st of November 2025 to the 30th of April 2026. And it shows us exactly what the funds were invested in and how they performed. First up, let's look at the Manning and Napier Fund Incorporated itself. This is a big filing and it is broken down into different series or funds. We're focusing on the financial tables here because they tell the real story of how these funds are doing. The reporting period we are looking at is from the 1st of November 2025 through the 30th of April 2026. Let's dive into the equity series. This fund had net assets of $55,916,147 as of the 30th of April 2026. That is a solid chunk of change, but what is really interesting is how it is invested. The report shows their sector allocation. Information technology makes up the biggest slice at 26.3%. That means a big part of this fund is betting on tech companies. Not too surprising given the market, but it is good to know where the money is going. Another key detail is the sector allocation. After information technology, financials were the next biggest at 19.2%, and then healthcare at 11.0%. So the fund is heavily weighted towards these three sectors. This tells us the managers are really focusing on growth potential in tech and stability, or upside in financials and healthcare. When we look at the top investment types, it is no shocker that common stocks make up the lion's share at 97.1%. This confirms the focus on equity growth. The remaining 2.9% is in cash, short-term investments, and liabilities, less other assets. This is pretty normal. Keeping some cash on hand for flexibility and redemptions. Now let's dig into the actual holdings. Remember, this is as of the 30th of April 2026. In the communication services sector, Alphabet Inc. Class A is a major holding worth $3,617,505. Meta Platforms Inc. Class A is also there with a value of $2,149. These are big tech names, as expected. In consumer discretionary, Amazon.com, Inc. is listed with a value of $3,549,949. That is a huge chunk, showing confidence in online retail and cloud services. Jumping to information technology, NVIDIA Corp is a significant holding with shares valued at $3,620,399. Given NVIDIA's performance recently, this makes sense as a strong performer for the fund. Microsoft Corp is also a big one, worth $3,212,899. Looking at the overall investment portfolio, the total investments are listed at $56,379,926. This is stated as 100.8% of net assets. The identified cost was $46,750,817. That difference between the cost and the current value shows a gain, which is what investors want to see. Beneath the assets, we see the liabilities. The total liabilities are listed as $485,085. This is a pretty small number compared to the total assets, which is a good sign for the fund's financial health. Now let's check the statement of operations. For the 6 months ended the 30th of April 2026, the net investment loss was $31,410. This is a small loss, but it is important to note that this is offset by gains on investments. And that is where the numbers get really interesting. The net realized gain on investments was $6,429,675. That is a massive gain that more than covers the small investment loss. However, the net change in unrealized appreciation was a depreciation, meaning a loss of $7,051,067. This is common in volatile markets where paper gains can disappear quickly. Because of these unrealized losses, the net decrease in net assets resulting from operations for the period was $652,802. It's not unusual to see a decrease when the market is a bit shaky, even with strong realized gains. Now let's look at the financial highlights for Class S shares. The net asset value per S-share at the end of the period was $14.03. This is down from $15.73 at the beginning of the period. This drop is mainly due to those unrealized losses we just talked about. The expenses ratio for Class S shares is listed as 1.05%. This is considered moderate in the fund industry. The footnote here is key. It says the investment advisor did not impose all or a portion of its management and other fees, and even paid some expenses. If they had charged everything, the ratio would have been higher, going up by 0.31%. This means the advisor is absorbing some costs, which is good for shareholders. The net investment income, when expressed as a ratio to average net assets, was negative 0.10%. This is that small loss we saw on the operations statement. For the 6-month period, the total return was negative 0.59%. This reflects the impact of those unrealized losses on the fund's overall performance for this shorter period. However, looking at longer periods, the returns are much more positive. For the year ended the 31st of October 2025, the total return was 9.87%. That shows the fund can perform well over longer stretches. Next, let's shift over to the overseas series. This fund had net assets of $303,935,112 as of the 30th of April. 2026. A big point here is the sector allocation. Information technology is the largest at 24.2%, followed by industrials at 19.3%. This fund is really focused on global tech and industrial companies. Looking at specific holdings in communication services, Auto Trader Group plc in the United Kingdom is a big one, valued at $8,945,836. Also, Tencent Holdings Limited from China is listed. This shows a clear international focus. In information technology, Taiwan Semiconductor Manufacturing Company Limited is a major holding valued at $22,985,342. That is a massive investment in a key chip maker and shows a bet on global supply chains. Similar to the equity series, common stocks are the dominant investment type at 94.8%. Let's check the financials for overseas series. The total assets are $306,067,494, while total liabilities are much smaller at $2,132,382. This looks financially sound. The statement of operations shows a net investment income of $609,497 for the period. This is positive income, which is good to see. The net realized gain on investments was $27,091,011. That is a very strong gain. But similar to the equity series, there is a big unrealized loss here as well. $16,537,311. The market is challenging and paper gains can vanish. Even with the unrealized losses, the net increase in net assets resulting from operations was a positive $11,174,904. This indicates the fund is growing overall due to its realized gains and solid income. Looking at the Class S financial highlights, the net asset value per S-Share at the end of the period was $37.36. This is up from $36.48 at the beginning of the period, showing growth despite market volatility. The expense ratio for Class S is 1.05%. The footnote mentions the advisor waived some fees, which would have increased the ratio by 0.08% if charged. This is a fairly standard expense ratio for an international fund. The net investment income ratio is 0.89%. This is positive, meaning the fund is generating more income than it spends on these specific expenses, which is a good sign for profitability. Now let's check out the ProBlend Moderate Term Series. This fund has net assets of $271,911,620 as of the 30th of April. 2026, a major part of its portfolio is in common stocks at 42.3%. What is interesting is the diversity of its bond holdings too, including corporate bonds at 14.6% and US Treasury bonds at 11.6%. This mix suggests a strategy that balances growth with some stability. In terms of sector allocation, financials lead at 13.3%, followed closely by information technology at 12.2%. This is a bit different from the previous funds, showing a slightly more balanced approach across different growth sectors. The top investment types confirm this focus on common stocks at 42.3%, but also highlight their significant bond holdings. Corporate bonds are at 14.6% and US Treasury bonds at 11.6%. This blend is a hallmark of a moderate risk strategy, aiming for growth but also looking to cushion downturns with fixed income. Let's look at the financials for the ProBlend Conservative Term Series. Total assets are $281,728,696, with total liabilities at $3,648,221. This is a very healthy ratio of assets to liabilities. The statement of operations for this conservative fund shows a net investment income of $3,766,798. This is strong income generation. Net realized gain on investments was $6,065,494. This is a solid gain from selling assets that have appreciated. However, like the others, they faced an unrealized loss on investments of $6,682,072. Despite the unrealized losses, the fund saw a net increase in net assets resulting from operations of $3,150,220. This shows that the realized gains and income were enough to overcome the paper losses and grow the fund overall. Looking at the Class S financial highlights, the net asset value per S-share ended at $13.45. This is down slightly from $15.73 at the start of the period, reflecting those market challenges. The expense ratio here is 0.90%, which is on the higher side, but the footnote is important again. It states that the investment advisor absorbed a significant portion of these fees. If they hadn't, the expense ratio would have been a much higher 1.05%. This suggests the advisor is actively managing costs for shareholders. The net investment income ratio is 2.75%, which is quite good. It means the fund is making a good amount of money from its investments relative to its costs. For this 6-month period, the total return was 1.11% decreasing, but the year-end return for the 31st of October 2025 shows a much more positive 6.56%, indicating growth over a full year. Now, Disciplined Value Series. Now, let's move to the Disciplined Value Series. This fund has net assets of $146,211,103 as of the 30th of April, 2026. Their portfolio is heavily invested in common stocks at a massive 98.8%. This strongly suggests a strategy that is looking for value in the stock market, with less emphasis on bonds for stability compared to the pro-blend funds. Sector allocation shows financials as the largest at 25.1%, followed by healthcare at 20.3%, and energy at 15.6%. This is a very different mix, with a strong focus on financials and energy sectors that can be cyclical. As expected, common stocks dominate at 98.8%. This confirms the aggressive equity focused strategy of this particular series. The financials here look solid. Total assets are $146,390,244, with total liabilities at a mere $179,141. This indicates a very strong balance sheet with minimal debt or short-term obligations relative to its holdings. The statement of operations shows a net investment income of $1,653,730 for the period. This is a healthy income stream. The net realized gain on investments was an impressive $14,235,916. That is a significant profit from selling appreciated assets, even with a market downturn reflected in the unrealized gain of $7,290,588. The realized gains more than compensate. This results in a very strong net increase in net assets, resulting from operations of $23,180,234. This fund is clearly growing and delivering on its objective. Looking at the Class S financial highlights, the net asset value per S-share is $8.72. This is up from $8.18 at the beginning of the period, a nice increase showing resilience and growth. The expense ratio for Class S is 0.82%. This is quite good, especially for an actively managed fund. The footnote also mentions fee waivers, meaning the actual cost to shareholders was likely lower than this ratio suggests. The net investment income ratio is 1.99%. This positive number means the fund is generating good income relative to its costs. Interestingly, this report highlights changes in portfolio management for the Disciplined Value Series. Effective the 1st of March 2026, 2 managers no longer serve, and 1 new manager joined. This is important information tracking leadership at the fund level. Finally, let's touch on the Rainier International Discovery Series. This fund had net assets of $385,616,063 as of the 30th of April 2026. Their common stock holdings are very high at 96.2%. The sector breakdown is quite diverse, with financials leading at 19.0%. Followed by industrials at 33.3% and information technology at 14.0%. This fund seems to be taking a broad global approach to growth. Looking at specific holdings in communication services, Auto Trader Group plc in the United Kingdom is a major investment with shares valued at $8,945,836. In information technology, Taiwan Semiconductor Manufacturing Company Limited is a significant holding valued at $22,985,342. Common stocks make up the vast majority of the portfolio at 96.2%. Checking the financials, total assets are $387,714,865, and total liabilities are $2,098,802. This shows a very strong asset base compared to obligations. The statement of operations shows a net investment income of $1,252,365. It is positive and signals a functioning income stream. The net realized gain on investments was a very strong $29,863,544. This indicates successful asset sales. However, they also saw an unrealized loss of $11,851,149. Again, market volatility impacting paper gains. Despite the unrealized losses, the net increase in net assets resulting from operations was a substantial $42,820,712. This fund is definitely growing. In the Class S financial highlights, the net asset value per S-Hair was $30.71, up from $28.23 at the start of the period. That is a good jump demonstrating positive performance. The expense ratio is 1.40%. The footnote points out that some fees were waived, so the actual cost would have been higher. This is a bit higher than the other funds, likely due to the international focus and sub-advisors as mentioned. Overall, so what are my takeaways from these filings? The equity series and overseas series show a pattern of strong realized gains despite some market headwinds reflected in unrealized losses. The pro-blend funds, particularly the conservative and moderate term series, show a balanced approach with good income generation. The disciplined value series stands out with its high concentration in common stocks and strong growth in net assets. The Rainier International Discovery series shows aggressive international equity investing with impressive realized gains, though also facing market volatility. All these funds appear to be managed with an eye on costs, with advisors absorbing some expenses to benefit shareholders. It is clear these funds are actively managed, seeking returns while navigating market ups and downs. The biggest risk I am watching is the impact of global economic events on these diverse portfolios, especially those heavily weighted in international or specific growth sectors. What I'm actually looking for is continued resilience and positive net asset growth despite market uncertainty. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Fire overall.